to the market risk, Mohamed, the triple R's, ratcheting of tariffs, rollback of tariffs, or rest as we are. Are the markets underpricing the risk of a ratchet in these tariffs? Good morning.
Good morning, Manus. I think two things. One is the markets have become mainly single issue, and the single issue is about trade. And I think there's optimism, not that we'll get a mini deal, I think we will, but that will be a stepping stone to something much bigger. The second issue is beyond the trade issue. There's a real strong tug of war going on between liquidity and favorable technicals and what remains a very sluggish global economy. So I view it as short-term constructive, but with major medium-term uncertainties.
Mohamed, we were earlier speaking to one of the key people at UOB, and he was making the assertion that 60% likelihood that you're going to see some kind of agreement, 30% that you're going to see an escalation. But those numbers are hard to really implement in any meaningful form. Are you a bit more convinced that we're going to get something? Are you higher a percentage than our guest earlier?
Yousef, I think we will get something, but it's not going to last. It is not going to be a stepping stone to a durable resolution. And that is for four reasons. One, most importantly, the mini deal doesn't address many of the long-standing issues. Two, let's not forget that there is more than just economics at stake. There's also national security issues and even human rights issues. So it's not going to solve quickly. Three, there's a sense in the US that if you don't stand up to China, when will you stand up to China? And four, technology accentuates all this. So I'm of the view that, yes, we may get a temporary ceasefire, but these trade issues aren't going away.
With that in mind, Mohamed, Goldman's have a note out this morning that we're going to see a fear-driven demand for gold. It's going to be strong as ever. I bring it to you because they're saying it can act as a balancer against my bonds in my portfolio. Would you subscribe to that as a view that fear-driven demand is as strong as ever? Gold cannot fully replace government bonds, but it can reallocate a portion of your bond exposure to gold.
So I think the issue of how to risk mitigate is a major headache for investors. And for the simple reason that bonds don't have that much offset to movement in equity prices. Now, so far, that's been great for investors. I've said we've been living the dream in 2019. We got higher equity prices. We didn't have to pay for risk mitigation. Bond prices went up. And we got virtually no volatility. Looking forward, however, it is a concern that it's not easy to have risk mitigation. I prefer cash because cash gives you one added characteristics, and that is agility. I do believe we're going to enter a period of greater volatility. I think that volatility is going to hit both good fundamental credits and less good fundamental credits, and you want cash to be able to pick up good names at lower prices.
Well, I know Manus is struggling to figure out what to do with all the cash that's sitting in the bank, but I want to circle back to what's happening with China. GTV Go for our clients, the numbers were pretty clear on the export side and on the import side, rising for the first time since August last year for imports from the US and exports continuing to slide for a 12th month. What do you think policymakers need to do here, Mohamed, to try and keep a level of resilience in the Chinese ecosystem?
So I think, as your reporter rightly said, this is about more than the trade war. This is about sluggish global demand, and this is about an ongoing process of moving away the outsourcing from China. Increasingly, you're going to hear foreign companies treat China the following way: in China for China, as opposed to in China to supply all our other markets. And that's a critical difference. So there's going to be a multi-year period of adjustment. What the Chinese authorities have to do, Yousef, is to accelerate their reforms. So far, they've been relying on short-term stimulus. And I think that there's an understanding in China that what you really need to do is press harder on the reform accelerator, because that's the only way you're going to promote genuine domestic demand to compensate for the weaker external demand.
In China, for China, Mohamed, has many risks for the global markets. What is the biggest risk of in China, for China to markets?
So I think the biggest risk, Manus, and it is a material risk, is that this is part of a bigger process of deglobalization. Look, what we've done so far is press the pause button on globalization. And the assumption in markets, and for most economic forecasts, is that this will be followed by pressing play again on globalization. There is concern, and this is a major risk, that the next step may not be play, therefore continued globalization, it may be secular deglobalization. And if that's the case, neither the global economy nor global markets are wired for a period of deglobalization. So keep an eye on this. I think that it's too early to say which way we're going. And that's why I said earlier that the medium-term uncertainties are material at this point.